Welcome to the latest edition of our virtual investor video series. My name is Susanne Matern and I'm responsible for the European Structured Finance Analytical team. Today I'm joined by Euan Gatfield, the head of our EMEA CMBS team, and we will be discussing the impact of the cost of living crisis on commercial real estate. So Euan, where do you see the greatest vulnerabilities on commercial real estate?
I think retail and leisure remain the most exposed to what we're seeing develop. We identified in January these sectors as most exposed to rising inflation, and things have intensified since then, including stuttering sales in the online sector as well. We've seen profit warnings, which suggest that perhaps the logistics sector might be brought into the fray in due course as well. Both retailers and logistics operators suffer from low margins traditionally. And so even if wages do keep pace with prices, this is a headwind insofar as it represents a big part of their operating expenditures. Worse would be a situation where wages stagnate, because of course this will affect household spending further. In terms of retail property, European malls tend to have resisted the difficulties of the pandemic a bit better than in the UK. Largely, I think, because of lower online penetration, there's less physical saturation per capita. And in Italy, where we do have some coverage, there's often a convenience or grocer anchoring dimension to those malls, which stabilizes footfall. In the UK, there has been quite a significant problem emerging since the pandemic. Most of the malls that we cover have seen values fall quite considerably, north of 40%, and in some cases greater than 60% since 2018, which is a considerable shock, and unsurprisingly our ratings have come down. The logistics sector, I think, has been one of the beneficiaries of the pandemic, surprisingly. We've noticed that big box formats, say pan-European, the largest end of the spectrum, all the way down to local trading estates and last mile or light industrial units, they've all done pretty well. We've seen UK secondary portfolios in our observation rise by 40% in value through the pandemic, which is a staggering performance. But what it does mean with yields so low is that there is a vulnerability now in the sector to rates rising. We might see a soft landing if rents continue to rise. That would allow yields to widen without hitting value. But I think this is looking a bit less plausible given the extent of the crisis that's emerging. You know, energy costs are a big part of industrial tenants' bills, and we have some solvency concerns as well. So I think this one is potentially due for some form of correction.
And you mentioned the risks from rising rates specifically for the logistics sector. Are there any other risks from rising rates you see?
Yes, any prime shiny asset, particularly in Europe, on the continent, has benefited over several years now from falling yields. The Brexit vote in 2016 probably acted as a floor on yields in the UK, although that cushion is now being eroded by rising rates from the Bank of England. But on the continent, certainly prime offices, we've mentioned logistics of all kind, and even residential, these are at all-time highs last time we looked. And therefore, we could see yields start to tick up because the underlying reference, which is government bonds, are now starting to rise. So we'd be a little bit concerned if, you know, for lenders that have maybe bought too much into this low for longer narrative, by writing loans on low debt yields. We don't have much of that kind of credit in our portfolio, but I think those kind of loans could face extension risk, perhaps even credit loss, if the ECB makes further changes to interest rates, or the widening spreads from the CMBS market spill over into the loan market. So really there's very few bright spots in CRE generally, given this rate environment. One might think that higher yielding properties, you know, might be a place to take refuge, although operating assets in particular face greater concerns from a recession, which is also brewing. So we might well see those kind of assets fall as well.
And now let's move from cyclical to secular risks. We had a lot of discussion about office that is interesting to debate because it's impacted by the shift to hybrid working, but potentially also by the ESG topic. So maybe could you briefly discuss how these two components impact the office market and what's your take on it?
Yeah, I mean, we're sticking to our view that we expect a steepening in the value gradient from high to low quality offices in centralized office markets. You mentioned hybrid work. We think that's here to stay. And in due course, we might see some office tenants elect to downsize their space requirements and hand units back. We see this as sort of bounded by two potential scenarios. The more bearish case would be if next best use for offices that are no longer viable, namely residential, if that is impacted over time by the lack of requirements to commute. So inner city housing may be less of an option, in which case those offices may remain as offices and have to compete on price. And that could transmit a shock throughout the office market in terms of falling values. The more optimistic case would be where actually there is this off-taker for non-viable offices in the form of residential, perhaps hospitality. But you mentioned ESG, and I think the renewed focus and likely to be a growing focus on carbon is a headwind because, well, let's say demolition and rebuild is probably going to be less and less acceptable. And even retrofitting will likely become more costly, in which case it may challenge some of these business plans. But just a final thought on ESG and embodied carbon, that the same concern around new supply could actually ultimately provide a support for office values.
Makes sense. Now, thanks a lot for your insights, Euan. And thank you all for joining us. And should you have further questions, please send us an email to the address on the screen.